So what are some criteria to consider when using position sizing?
Well, I think you have to decide what is it you're going to try to manage. In my case, I wanted to make sure I manage the risk of the trade because that is loss of capital, and that's pretty near and dear to every trader's heart. Second thing is to manage volatility, and that came out of my silver trade because I realized that the more volatile a position is, the more you're likely to get emotionally attached or emotionally attracted to the good and bad of that movement. So volatility to some extent is risk because it risks your mental state. So unless you can turn your brain off, and some traders can do this, I can't. Frank, I admit I must be weak mentally or something in this regard, because if it's too volatile, it attracts my attention, and I don't want it to attract my attention. So I manage those two. There's then the possibility, mathematically speaking, that some positions have so low of a volatility and so low of a risk on the trade because the volatility has been very quiet and the market's gone sideways for an entire summer or something. And you're getting these numbers that are insane when you size the position. It's very large position size. You might want to also cap it by a percent of equity or percent margin to equity. And if you do those three things together, I think you keep yourself away from any kind of debacle that would really sink your ship. And that's kind of the nature of trading, is you want to come back and play the game tomorrow. And you can't ever let yourself get knocked out of the game.
Absolutely. It's about longevity in the markets. And you've certainly had that with 45 to 50 years of being in the market.